Welcome to the 401k Audit CPA Success Show, where we're 100% focused on helping companies across the United States prepare for their 401k audit. If you have 100 eligible participants in your 401k plan, then this podcast is for you.
Welcome to today's podcast. Today, I am joined once again by Kim, our audit director, and we are going to touch on a very important issue for all the plan sponsors out there. The Secure Act was passed recently, and so Kim's going to give us a little bit more information about what that means to you from a plan sponsor and kind of the action steps you can take and anything you need to do going forward based on this act. So let's start in the beginning. Kim, explain the Secure Act passage and kind of what it when it happened.
Sure. Good morning, everyone, or good afternoon, wherever you might be. The Secure Act we wanted to talk about, it's been kind of ongoing in the press. You may have heard some things or seen some things online about it. It's a bill. It started in the U.S. House of Representatives, so it is a congressional act. It started back at the beginning of 2019. It actually passed the House back in May and then went over to the Senate. The Senate had a slightly different version, as is pretty typical for bills that are going through our congressional legislative process. The Senate had another bill. They kind of went back and forth. It got hung up in the Senate. So it sat there for the majority of the year. And we weren't sure if it actually was going to pass at the end of the year. But there's a lot of pressure. A lot of people wanted it to pass because there are some really good opportunities for plans to take advantage of with the act. And so it actually was pressed in as part of the budget appropriations bill that happened at the end of the year, which of course the main purpose of that is to fund the government for another period of time. But they kind of snuck this in along with that budget bill. So it actually got passed very end of December 19th, and President Trump signed it, made it effective December 20th. So as of right now, it's passed, it's in effect. We're going to talk a little bit more about the different components of it and what that means to potential plan sponsors. And everybody needs to be aware that even though the bill was passed and it went into law at the end of December, there are various different timing for the different components. So just because it went into law the end of December 19, some things are not in effect as of right now. So we'll kind of talk a little bit more about that, but just to be aware, just because it's in effect doesn't mean everything came in at the same time period.
So we know our government officials are very creative because secure is an anagram, right? So can you tell everybody what it stands for?
It sure is. They, it's amazing to me. They can be creative on some things, and then other things that are probably more important, they seem to have trouble with. But you're absolutely right. Secure is an acronym. It's spelled SECURE, as you would expect, but that stands for Setting Every Community Up for Retirement Enhancement Act. So it's quite a mouthful. What it's really all about, Congress, as well as a whole lot of other folks, have realized that a lot of the citizens out there in the U.S. are not saving enough for retirement. And so they're trying to do everything they can to take the burden off of Social Security. And we're not going to get into the whole discussion about Social Security and problems with funding for Social Security, but I think everybody realizes there's some issues there, and they really shouldn't have citizens relying exclusively on Social Security for their retirement income. So they're trying to do everything they can to help make it easier for companies to sponsor retirement plans, and then for employees in those companies to be able to participate and make it as favorable as possible. And that's what this act was all about. So that's kind of the basis.
You gave me some interesting statistics on this. I wonder if you want to go into those a little bit, because I'm reading those right now. And I'm like, I can't. That's amazing to me that's where the data is.
The data just is not good. I pulled up just a couple of statistics, and you can go online and look for others. But the U.S. Bureau of Labor Statistics, which does all kinds of statistics about the workforce and people's compensation and all of that, did a study in 2018, so not that long ago, that said only 55% of adults in the U.S. participate in a workplace retirement plan. So they either don't have the ability to participate, maybe their company doesn't have a plan, or for whatever reason they've chosen not to participate. So that's almost half of the people in this country are not participating in any kind of retirement plan, which makes you believe they're probably not saving for retirement, which is really scary when you think about when they actually got to retirement, what's going to happen. Another study, Vanguard, of course, very large investment firm did a study last year, 2019, and it showed that the average 401k balance for those 65 years and up, so those either at retirement age or very close to retirement age, their average retirement plan balance was a little over $58,000, which, great that they have a plan and that they have an account with some money in it. So, I mean, that's a good thing. But $58,000, as we all know, to get you through your years from retirement until your death, it's not going to be nearly enough to get people through. So there's just a huge gap there, but also you like to look at it as a huge opportunity as a company, as a plan sponsor, to help your employees prepare for retirement. A great benefit that you can offer them if you're not, or to enhance the benefit if you are offering some type of retirement plan to your employees.
Yeah, for sure. So how does this act encourage me as an employee or the sponsors to get our employees to participate in benefit plans then?
Yeah, so there's several different provisions that are a part of this act. And first off, I'd say I would encourage anybody who is really thinking about implementing any of these to go do a little bit more research, because obviously we're limited on time today. So we're not going to be able to go into all of the details. And as any congressional act goes, it's very lengthy and has a lot of details to it, which we're not going to go into all of the different details. But there's there's actually three kind of buckets that the law addresses. One is helping employers, and especially focused on smaller companies, helping them to be able to offer affordable plans to their employers. Because one of the things that they've recognized is that for very small employers, they may want to offer a plan, and they really, they're all about giving their employees the best benefits that they can, but it can be very expensive, and they just may feel like it's not a cost benefit to them, or they just can't afford it, quite frankly, to be able to offer a plan. So there's some provisions around that. Then there are things to look at employee participation, looking at some of the rules around folks that are in a retirement plan, trying to make it easier for them to participate and easier for them to get access to their money. There's also a recognition that people are living longer. So they changed the required minimum distribution rule slightly to help with that. Then there's a third bucket, which is just kind of some general stuff. We're going to talk just a little bit about that. So let's start with, I'm an employer and I'd like to offer a plan, but maybe for whatever reason I found that it's very expensive. So I have not done that in the past. What does this law do for me? One of the big things that it allows is, if you're a very small employer and you've done some research and you felt it's too expensive, there are administrative costs to the employer to offer a plan, and maybe you felt like that was too expensive for you as a small employer, this rule allows you to group together with other similar small employers and offer one plan to that combined group of employees. So maybe 4 or 5 or 10 companies would band together and say, we're going to offer one employee benefit plan to all of our employees. Obviously, it's got to be the same plan, it's got to be the same benefits, but it allows them to share the cost across all of those companies, which makes it more affordable to the small employee.
So are there going to be organization vehicles that help with that, kind of like a PEO on the insurance side, or is it going to be just going to small business associations and trying to find similar companies, or how would you go about grouping with another company?
Implementing it. The PEO option is applicable even before this act. So you certainly could do that. That would be one type of way of getting around this. But I would suggest, if you're a small employer and you're thinking, okay, so how can I take advantage of that? There's a couple different things you can do. One, you could, you probably know other folks in your community that are other small business owners, so you could talk to them just kind of as a side discussion about, would you be interested in pooling together to try to offer a plan? What probably would be an even better option is to go to your providers that you already have. So if you're working with a payroll provider, talk to them and see if they have something available that you could work with. Also, just go online and look at the folks that are offering 401k plan administration. That would be your big payroll companies, big insurance companies, and the big, like a Vanguard, your big investment providers. They all generally offer 401k plan sponsorship. And so you could talk to them and see if they're doing anything in this space. Obviously, this bill just got passed. So we're a little ahead of the game. They're probably still working out the details of that. But I think if you would go to some of the big providers like an ADP, like a Vanguard, like a Fidelity, some of the big insurance companies, they're going to be putting together plans that will allow small employer groups to get together. Another option is if you have an investment advisor, maybe for some other purpose. You may have an investment advisor for something within your company, or you may use an investment advisor personally, for your own personal investments. You could talk to them and see if they know of other companies that would like to band together, or maybe they're putting together an offering themselves. It's a great opportunity for the investment advisor community out there to sell some services too. So I think those are all avenues you can pursue to look into this. And then, as is with anything else, you're going to have to evaluate the different options available. Look at cost, look at the service that they're going to provide, look at the investment options that are going to be available to your employees. You want to do the best of all of those, just kind of sort through them and make a choice. So I think there's going to be a lot more options out there and a lot more coming over the next few months now that this has been passed.
Great. No, I think that's really helpful. So what's you talked a little bit about that part of the provision. So what's the next provision that you introduced there?
Yeah, along with that, it's going to allow the employers, if they band together, to file one 5500 for those combined plans. Now, there are some rules around that. We're not going to go into the details of that, so you'd want to check that out. That helps from an administration standpoint. It also, this bill puts in a safe harbor provision. So if, for example, 10 companies banded together to offer one 401k plan, it offers a safe harbor to each of those individual employers. So if one employer group falls down on the job and doesn't do whatever it is that they're supposed to do administratively with regard to the plan, it doesn't cause liability to the other 9 employer groups and wouldn't disqualify the entire plan. It potentially could disqualify that one employer group, but not all of them. So it does provide a safe harbor. So that's nice. Another thing that it does, hoping to increase employers offering a plan and also participants to participate in the plan, is that they are providing tax credits. They're small. They're around $500 up to around $5,000 credits. Now, this would be a credit to the employer on their employer tax return. One for offering a plan. So if you're not offering a plan currently and after this act goes into play, you do offer a plan, you can take a tax credit. There's a kind of formula you have to work through to figure out what the credit would be. Same thing for participation. If you either are putting in a new plan or you already have a plan, this is something you can take advantage of if you already have a 401k plan. If you implement what's called Autoenroll into your plan, then there's, again, another tax credit that the employer can take advantage of. And again, there's a calculation go through to figure that out.
Outside of the tax credit, is that something you'd recommend? Do you like the auto enroll feature?
Yeah, auto-enroll has its kind of pluses and negatives to it. The way auto-enroll works, in case you're not familiar, you set up as part of your plan document that you're going to implement auto-enroll, and you still set whatever your eligibility requirements are. Usually that's an age and a service requirement. So you may say an employee can enroll in the plan once they're age 21 and they've worked for the company, let's say 3 months. And those can vary, obviously. But with auto-enroll, once an employee hits both of those requirements, so they're over the age of 21 and they've worked for you for 3 months, then this auto-enroll would kick in and they would automatically be enrolled in the 401k plan unless the employee elects not to. And so that's something they have to do on their own. So if they do nothing, they're going to be auto-enrolled, and it's at whatever you state in the plan document. Usually it's something around 3%. They get automatically enrolled either immediately or within a period of time. And if they don't elect investments, it will select a default investment election for them. The good thing with that is it can increase your plan participation, which is, what this is all about, is getting people to save for retirement. I don't understand this and I can't explain it, but people, when you do auto-enroll, they generally won't opt out. They just won't take the actions, even though it's filling out a form. They won't fill the form out. If you have the exact same requirements, but you ask them to fill the form out to opt in, then you get a much smaller participation rate. So, it's the same end result. I can't really explain why that is, but that is what we've seen with a lot of our clients. So it
Because
does
those forms
increase.
are scary.
Yeah, I guess, and it's
There's
just,
3 words on it, but it's scary. It freaks you
and
out.
we're all busy. I think it's just one more thing you got to do in a busy life. So it does increase plan participation. Now, on the negative side, from the plan sponsor standpoint, it can increase some administrative work, because if you have high turnover in your employee base, just depending on the type of organization that you are, you have a lot of people coming and going. You have a lot of part-time people, a lot of hourly people that their compensation is going to change from period to pay period. Those people tend to turn over a lot, and so you may have a lot of folks in your plan with very small account balances. So you may have, hundreds of people with account balances under $50. And then you've got to pay for those people, so it can increase your administrative costs. You've got to eventually get the money out of the plan for those people, so you've got to go find them. You've got to get them to fill out a form sometimes to get the money out of the plan. So you kind of want to weigh that. Is it worth that? Do you have staff to handle that? Because you don't want to get into auto enroll and then you can't keep up with with all those people in the plan. So it's kind of a balancing act. But there is good and bad. We've seen a lot more of our clients going to this. Another feature that goes along with auto enroll, it's not automatic with it, but you can implement it at the same time or later on, is something called auto escalation. And this plan did change the maximum escalation from a 10% cap to a 15% cap. The way auto escalation works, if you had auto enroll, you're going to auto enroll your folks at whatever you set. Usually 3% is something that we see quite often. And then once a year, on a date that you would set as part of the plan document, that percentage goes up a percentage each year for the employee until it hits that maximum cap, which again is going from a 10% to a 15%. So for a new employee, they would get auto enrolled, in this case at 3%. The following year, it would bump up to 4%, the following year to 5%, et cetera, up until it reaches that 15% cap. Again, unless the employee opts out. So the employee at any point in time could say, nope, stop at 5%. I don't want to go to the 15. Or maybe I'm up to 10 and now I don't want to be at 10% anymore. I want to go down to 5%. So they can always change that, but it's going to auto up it until it hits the 15%. Again, helping people save more for retirement and assuming that their compensation, is going to increase. It's going to allow them to save more. So that's kind of how that component works.
Great. So before you get to the other 2 provisions, I think there's 2 left that you were going to talk about. I'm just going to throw our email address out there. So we're always looking for new topics and guests or anybody else that has any information for the show. So if you have any questions or topic suggestions, please email us at audit@summitcpa.net. Again, it's audit@summitcpa.net. We're always looking forward to get the listeners involved, so please reach out to us. So with that said, Kim, what are the final 2 provisions, and give us a little bit of info on them?
Sure, and I would echo your reach out to the listeners if you also have any questions just off of the podcast. I know we're going through a lot of kind of detailed information in a short period of time, so feel free to just email questions as well if you have them off of the podcast or you'd like more information. Be happy to help you out. The other couple of things from a participant standpoint, there's a couple of things that it changed. I won't go into all the details, but it does allow an in-service withdrawal if you have a birth of a child or you're adopting a child, and that's up to a $5,000 distribution. Most 401k plans won't let you take money out of the plan until you retire or terminate service with the employer, except for certain very specific situations, and this allows an additional situation for birth of a child or adoption of a child.
So that's with no penalty. It's just you can just take that $5,000 straight out, and there's no penalty for that. That's a interesting
no
provision.
Penalty. Now you will have to pay tax on it.
Yeah,
the IRS is going to get their chunk,
of
but
course.
no penalties. So
okay, great.
Recognizing that they want to help younger families out. Also, it raises the required minimum distribution age slightly. It didn't increase it significantly, but it's going up from 70 and a half up to 72. And I'd look for more in this space going forward. That there's been a lot of talk that they may raise it up potentially to 75. Just recognizing people live longer, wanting to make the money in your retirement account last for your entire lifetime. So they're looking at raising those ages. Now, doesn't mean you can't take it out sooner, but it's just saying you're not forced to take the money out at an earlier age. One other thing, they're going to require disclosures around the income from your retirement plan. It's a new disclosure. We don't know exactly what it's going to look like, but it's called the lifetime income disclosure. So it will require the plans to disclose to you, based on the amount of funds in your account, what type of monthly benefit you could see once you hit your retirement age. Obviously, it's a forecast because they don't know when you're going to retire. They don't know how long you're going to contribute. They don't know what the stock market's going to do. But similar to the forecast that they do for Social Security, they're going to put in a disclosure requiring that.
Will that be a general disclosure in the financial statements, or would that be something that goes out to each individual participant with their amount they have in there?
No, it'll be a specific to each participant. Yeah, a specific disclosure based on your the funds in your account. So I think that's a great thing. More to come on that too, because that's not going to come in for another year.
Okay.
And I would advise everybody too to keep in mind that there are different due dates on each one of these things we've talked about. So look into that a little bit more carefully before you change your plan or adopt something, just to make sure you're not trying to take advantage of something too quickly. The last thing I wanted to mention, it did increase penalties for late filings on the Form 5500. If you're not aware, if you don't file the 5500 by their specific due dates, depending on what the plan reporting timeframe is, usually it's calendar year, which gives you a end of July original filing date and an extension to October 15th if you do file for the extension. If you miss those due dates, there are pretty hefty penalties in place already. It was $25 per day, up to a maximum of $15,000 penalty for filing late on the 5500. This act is going to increase that significantly, up to $250 per day from the $25 and up to a maximum of $150,000 fine. So pretty hefty fines. You're going to want to make sure going forward you get those 5500s done on time.
Now we know why it was part of the budget bill, right? It's because
exactly.
they're building that into their budgets.
Yep. That's exactly right. And Jamie, I'd just say there are some other things that we're not going to have time to get into today, but there are other provisions, and we can talk about those on a later podcast. By all means, email me at that email address that you gave out. I'd be happy to either go into more detail on the things we talked about or go into any of the other provisions. Check online also. There's a lot of information out, and there'll be a lot more coming out over the next few months about this act as it gets kind of rolled out and the providers get looking at it and figuring out how they're going to implement it on their end. So I'm sure there'll be a lot more details coming.
No, I appreciate it. I think you gave a lot of really good information. I know I learned a lot, and I know it takes a lot of work to go in and read an entire bill, and I'm sure you were spending some time doing that. So
yeah. It's not a lot of fun reading congressional legislation, as I'm sure all of our readers can sympathize with. So.
Great. Well, before we end the podcast, any final thoughts that you have on this act that you want the listeners to make sure they're walking away with?
No, just I think it's something to definitely take a look at, whether you're an employer thinking about implementing a plan, or maybe you already have a plan. There's some good things to take advantage of in there. We all want to help our employees have the best benefit package that we can, and that benefits them. And different employers have different employee bases. And some are younger, some are older, some have a lot of turnover, some don't, some have more hourly workers, some have more part-time workers. There's part-time provisions included in this act as well. So definitely, I think it's worth everybody's time to just scan it, see if there's anything you can take advantage of and help out everybody. We all need help preparing for retirement. So I think there's something in here for everybody.
Great. Well, once again, I appreciate your time, and we'll be back again next month with another great topic. So thanks for all you do.
Thank you.
Enjoyed this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving 401k audit success. We're here to be a resource with ever-changing rules and regulations.